Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's talk about quantitative investing. You've probably heard the term, maybe pictured a room full of supercomputers and math geniuses. Today, we're going to pull back the curtain on that black box. We're diving into the core ideas from the book Quantitative Investing, from theory to industry, to see how it all really works. Ready? Let's get into it.
So let's start with the big one, right? This is the question that keeps every investor up at night. For ages, the answer was all about gut feelings, maybe some deep company research, a bit of intuition. But quantitative investing comes at it from a totally different angle. It asks, can we use a scientific, data-driven process to find a real, repeatable edge?
So here's our game plan for today. First, we're going to look at the absolute must-have skills for any quant. Then, we'll get into the actual tools they use to find patterns in all that market data. After that, we'll see how this isn't just for stocks, it works for commodities too. And finally, we'll look at the future, where humans and machines are starting to team up in some really cool ways. Okay, first things first. Before you can even dream of building a winning strategy, you need a solid foundation. And we're not just talking about being a math whiz or a coding guru. It's about a complete package of skills that all have to work together perfectly.
These are the 4 essential pillars. Think about it. You've got to understand the playground you're in, the markets themselves, all their weird rules and behaviors. Then you need to know the theory, the big ideas that came before you. Of course, you need the statistical and modeling chops to actually test your ideas. And finally, you have to be able to code, to wrangle all that messy, real-world data and make it do what you want.
And this right here is the absolute key. It's like a 4-legged stool. If any one of those legs is wobbly, if you don't really get the markets, or your code is full of bugs, the whole thing just tips over. A single weak spot can bring down the entire strategy. They all have to be strong.
So you've built your foundation. The 4 pillars are rock solid. Now it's time to open up the toolkit and see how quants actually start to make sense of all the noise in the market. We'll start simple and build our way up.
The most basic place to start is just looking at one thing at a time. That's univariate analysis. So you might take the S&P 500 and just study it. What's its average return been? How much does it jump around? Does it have crazy, unpredictable days? You're basically trying to understand the personality of a single asset before you do anything else.
Okay, once you've looked at things in isolation, the next logical step is to start comparing them. That's where bivariate analysis comes in. You're asking, hey, when this stock goes up, what does that other one tend to do? Do they move together? Do they move in opposite directions? This is where you start to find interesting relationships that you can build strategies around.
You know, a perfect real-world example of this is comparing the US and Chinese stock markets. They are totally different beasts. The US market is mature, it's been studied to death, but the Chinese market, it's growing like crazy. You've got a lot of state-owned companies and way more speculative retail trading. Understanding how these 2 different markets relate to each other is absolutely critical for anyone investing globally. All right, now we're getting to the real heart of modern quant finance, the multi-factor model. Honestly, the best way to think about it is like a recipe. You're trying to predict which stocks will do well. Your ingredients are things called factors, like how cheap a stock is, how profitable the company is, or how much momentum it has. A model helps you figure out the exact right amount of each ingredient to get the best possible results. Now, when most people hear quant, they automatically think about picking stocks. But these tools and ideas are way more powerful than that. You can apply them to all sorts of things, including the wild world of commodities.
See, when you're analyzing stocks, you often look at thousands of them at one single point in time. That's called cross-sectional analysis. But with something like oil or gold, there's only one price of oil, right? So you have to shift your perspective. You focus on time series analysis, which is all about studying the behavior of that one thing over time.
This creates a really fascinating puzzle. If you look at a chart of oil prices and a chart of gold prices, they both just seem to wander all over the place, almost randomly. So how in the world could you ever find a stable, predictable, long-term relationship between 2 things that look so chaotic?
Well, there's this wonderful analogy in finance that explains it perfectly. Imagine a drunk guy walking home. His path is totally random. Now, he's got his dog with him, off the leash, and the dog is also wandering around randomly. But here's the thing. No matter how far they stray from each other, they're connected. The dog will always, eventually, come back to its owner.
That little story? That's the perfect description of a statistical concept called co-integration. You can have 2 things, like oil and gold, that both seem to wander around randomly on their own. But if they're co-integrated, it means there's some kind of invisible economic leash that keeps them tied together in the long run. Finding these pairs is the basis for some really powerful trading strategies.
Okay, so we've got the foundation, the tools, and some applications. Now let's talk about where this whole industry is going, because the big debate isn't just about man versus machine anymore. It's about how man and machine can work together.
To get it, let's look at the two classic styles. You've got quantitative investing, which is all about breadth. A computer can look at thousands of stocks at once and find tiny patterns no human could ever see. Then you've got traditional fundamental investing, which is all about depth. A human analyst can go incredibly deep on just a couple of companies. Both are powerful, but they're very different.
So you can probably guess what's next. The big question became, why choose? Why can't we have both? And that is exactly what Quantamental investing is. It's this hybrid that tries to get the best of both worlds, the massive scale of the machine combined with the deep, forward-looking wisdom of a human expert.
And when you combine them, you unlock some amazing advantages. A human analyst might have a gut feeling about a certain type of company culture, while a quant can help turn that feeling into a measurable factor and test it across the entire market. It's this beautiful mix of machine efficiency and human expertise, combining what happened in the past with what we think might happen in the future.
So really the big takeaway is that we're moving beyond just data mining, just letting a computer search blindly for patterns. Instead, we're building data-proven investment theses. It starts with a smart human idea and then uses the power of data to prove it, refine it, and scale it.
Which brings us right to our final question. As the computers get smarter and the data gets bigger, what's our role in all of this? The rise of quantamental investing really suggests the future isn't a battle between human and machine. It's a partnership, and that fusion just might be the most powerful force in finance yet.
All right, let's dive right in. We're going to explore a single question that the entire financial industry revolves around, a question that billions, if not trillions of dollars are spent trying to answer every single day.
So let me ask you this. Can you, or anyone really, consistently do better than the market average? I mean, it sounds simple enough, right? But it is one of the toughest puzzles in all of finance. For decades, the absolute smartest minds have been trying to crack this code. And sure, some have had a good run for a while, but doing it year after year after year, well, that's a whole different story.
Okay, now take a look at this. This slide tells you pretty much everything you need to know with just a few numbers. In any single year, a pretty good chunk of professional funds, somewhere around half, actually manage to beat their benchmark. And a benchmark is just the average they're trying to beat, like the S&P 500. But here's where it gets really interesting. Look what happens when you stretch that out over 3 years. Whoa, that number just plummets, down to around 25 or 30%. And 5 years? It's basically the same story. This shows you a really powerful truth. Getting lucky for a year is one thing, but keeping that winning streak going is incredibly, incredibly rare.
So, why is it so ridiculously hard? Well, it's because the modern market is just a brutally efficient machine. Information that used to be a secret weapon for an investor now flashes around the world in milliseconds. I mean, pretty much everyone has access to the same data, the same news. Technology has totally leveled the playing field, and you've got this constant flood of brilliant people all chasing the exact same thing. Any little advantage, any piece of what they call alpha, that's just the industry word for your edge, it gets found out and copied almost instantly.
But what if you came at this problem from a totally different angle? What if, instead of trying to outthink everyone with your gut, you relied on pure, cold, hard data? This is where a whole new breed of investor enters the picture, the quants.
So quantitative investing, or quant for short, is really all about building a system. It's about using powerful computers and really complex mathematical models to dig through mountains, and I mean mountains of historical data. The whole point is to find these tiny little patterns, these market slip-ups that a human would just never spot, and then build your investment strategy on those signals. The biggest thing, it's designed to take human emotion, all that fear and greed, completely out of the equation.
Here's probably the best way to think about it. A traditional investor, a fundamental investor, they're kind of like a film critic. They'll watch maybe a dozen movies a year, but they'll get to know each one inside and out. The director's style, the actors, the script. A quant, though, is more like a data scientist working at Netflix. They're not watching one movie. Their computers are analyzing the data from millions of people watching thousands of movies to predict what you're going to click on next. See the difference? One goes for depth, the other goes for massive, massive breadth.
And look, this whole idea wasn't some overnight thing.
It's been slowly evolving for decades, starting as this kind of nerdy academic theory and growing into this absolute powerhouse in the world of finance. It really all started back in the 60s, 70s, and 80s in university classrooms, where academics were dreaming up the theories and the very first computers were running the very first models. Then the 90s came along, and things started to pick up steam. These multi-factor models got popular, and the internet started spreading ideas like wildfire. But the 2000s, man, that was the explosion. That was a period of just insane rapid growth. And then, after the 2008 financial crisis, the whole industry had to kind of reinvent itself, evolving into even smarter strategies like smart beta, which is basically just a more advanced, rules-based way to build funds.
And this one number right here, this just shows you the mind-boggling scale of that boom. By the end of the 2000s, quant funds were managing something like $2 trillion. Let that sink in for a second. That is not a typo. $2 trillion. This wasn't some little niche strategy anymore. This was a central player on the world's financial stage.
Okay, so that's the big picture. But how does a quant fund actually, work? What does this model-driven thing look like on the inside? It's not some mysterious black box. It's actually a super-structured, really disciplined process.
It really all comes down to a 4-step playbook. First step is strategy. That's where you decide what you're trying to do, what your goals are, how much risk you're willing to take. Step 2, you build the alpha model. Now, this is the real brains of the operation. This is the secret sauce that crunches all the data to find that edge and predict future returns. Third, you have portfolio construction, where an optimizer takes all those predictions and builds the perfect portfolio based on your rules. And finally, trading. The system just does it all, executing the trades and rebalancing everything automatically over time.
So what's the whole point of all this structure? It's simple, really. It's about creating a process that you can do over and over and over again, consistently. It's designed to be transparent and, maybe most importantly, completely free from all those little mental mistakes. The fear, the greed, the overconfidence that trip up human investors all the time. And of course, none of this works without the fuel, which is data. And we're talking about tons of it. These models are hungry. They eat up everything from the basics, like company financial reports, to all the market pricing info, like historical prices and trading volume. And then they layer on top all the big picture stuff. Industry trends, government regulations, you name it. It all goes into the machine.
Now, this whole field didn't just appear out of nowhere. It stands on the shoulders of some absolute giants. These models we're talking about, they're the result of decades of brilliant work by thinkers who completely changed how we look at financial markets.
You could argue that it all starts with guys like Benjamin Graham, who's known as the father of value investing. He was the one who insisted on doing deep, objective analysis and having a margin of safety. He really pushed this idea that investing should be a disciplined operation, not just a gamble. And that right there is a core belief that drives the entire quant world.
And then, building on that foundation, you have these other brilliant minds, people like Harry Markowitz, who gave us a mathematical formula to balance risk and reward. Then William Sharpe came along and developed a model to actually put a price on that risk. And Eugene Fama took it even further, showing that stock prices are affected by a bunch of different factors, not just the overall market. So what's the big takeaway from all this? Well, together, these thinkers literally transformed investing. They took something that was always seen as more of an art, based on gut feelings and intuition, and they gave it the solid, rigorous framework of a science. And that single shift is the foundation that this entire multi-trillion-dollar quant industry is built on today. Which, of course, leaves us with a really fascinating and kind of mind-bending question for the future. We've seen this evolution from human gut instinct to data-driven models. So, as our data gets bigger and bigger, and as artificial intelligence gets smarter and smarter, where does this trend end? Is there a day coming when the human investor is just completely obsolete? Now, that is something to think about. All right, let's jump right in. Today, we're tackling one of the biggest questions in finance, one that's probably on a lot of people's minds. Is the U.S. stock market just way too expensive? We're going to approach this like a detective story, digging through the evidence, learning from a master of the craft, and using his tools to see if we can crack the case. So our whole investigation really starts right here. Just look at that climb. For almost 70 years, the S&P 500, which is basically a stand-in for the entire U.S. stock market, has gone on this absolutely incredible run. But it's obviously not a straight line, is it? You see those huge peaks and some pretty terrifying valleys. So the big question is, where we are now, is that just another step on this long climb up, or are we standing right on the edge of a cliff? So to figure this out, here's our game plan. First, we need to look at the historical data, set the stage.
Then, we're going to bring in an expert, a true master of investing. We'll get our hands on the tools he used, apply them to today's market to see what verdict we get, and then, most importantly, we'll figure out what it all means for you. All right, first up, let's stick to the facts of the case. We're diving into 70 years of S&P 500 performance to really get a feel for the character of this market.
Okay, so when you crunch all those numbers over that 70-year stretch, you get an average return of almost 7% per year, which, sounds pretty good. But look at that number right next to it. Annualized volatility, that's just a fancy word for risk, is over 14%. That's more than double the return. What that tells you is, yeah, the market went up over time, but it was one heck of a roller coaster ride to get there.
Now, to make any sense of that kind of chaos, we need an expert guide. And for this investigation, we couldn't ask for anyone better. We're turning to Benjamin Graham, a man who's literally called the father of value investing. He basically wrote the instruction manual on how to analyze markets, and his wisdom is going to be crucial for us. And you got to understand, Graham wasn't just some academic sitting in an office. His ideas were forged in the absolute fire of the Great Depression. He lived through the Roaring '20s, when people were borrowing crazy amounts of money to gamble on stocks, and then he watched it all burn to the ground. His entire philosophy comes from that real-world, painful experience of seeing fortunes just wiped out.
So, after seeing all that, Graham drew this incredibly sharp, clear line in the sand. He said, on one side you have investing, and that's when you do your homework, you protect your money, and you aim for a reasonable profit. Everything else, anything that doesn't meet those strict rules, he just called it what it is, speculation.
So let's break that down, because this is the absolute key to everything. An investor, in Graham's world, is somebody who analyzes a business to figure out what it's really worth, its intrinsic value. Then they just wait patiently to buy it for less than that. A speculator, they don't really care about the business at all. They're just betting on which way the price is going to move next, driven by feelings and market hype.
Okay, so if an investor's job is to buy stuff for less than it's actually worth, how in the world do you figure out what something is worth? Well, luckily for us, Graham gave us a really powerful but actually pretty simple tool to help us read the market's price tag.
And that tool is the price-to-earnings ratio, or just the PE ratio. The best way to think about it is like this. It's the price tag. If a stock costs $100 and the company earns $5 per share, the PE is 20. Simple as that. It just tells you how many dollars investors are willing to shell out for every single dollar of profit a company makes. It's a fundamental way to ask, is this cheap or is this expensive?
Now, this is where things get really, really interesting. When you look at the PE ratio for the whole market over the past century, you see something fascinating. For most of the 20th century, that price tag hovered right around 15. But look what happens from 2001 to 2019. The average price tag jumps way, way up to 22.5. What that means is that recently, we've all been willing to pay a much, much higher price for the exact same amount of earning.
Okay, so we have our history, we have our expert guide, and we have our main tool. It's time, let's put it all together, apply it to the market, and see what kind of verdict we get.
So here it is, Exhibit A in our case. On January 31st, 2019, the PE ratio for the whole S&P 500 was sitting at 20.76. But, a number like that is kind of meaningless on its own. We need some context.
And the context? Well, it's pretty shocking, actually. A PE of around 21 is in the 91st percentile. That means that in the last 120-plus years, the stock market has only been more expensive than this about 9% of the time. Think about that. We're not talking about just a little pricey, we're talking historically very, very expensive.
So that's it, right? I mean, the evidence seems pretty clear. High valuation, way above average. Should we just slam the book shut, label the market overvalued, and call it a day?
Well, not so fast, because every good detective knows there might be a twist in the story. And financial markets have this dirty little secret. The numbers they spit out don't behave the way a lot of math models think they should. Simply put, the market isn't normal.
You've probably seen this before. It's the classic bell curve. In this nice, clean, theoretical world, most things happen right around the average. Sure, big deviations can happen, but they get super, super rare the further out you go. An event that's way out on the edge, what's called a 3 sigma event, that's supposed to be almost impossibly rare.
But here's the twist. The real world of the stock market doesn't look like that perfect bell curve at all. It has what are called fat tails.
And all that really means is that those supposedly impossible extreme events, we're talking crashes and huge surges, they happen way, way more often than the models predict. And to make it even scarier, the curve is lopsided. There are a lot more days with huge losses than the model would ever prepare you for.
And these numbers right here, I mean, this is just mind-blowing. The model predicts a 3 sigma event might happen once every year and a half. The reality? It's happened more than 3 times per year. And get this, a 4 sigma event, something so rare the math says it should happen about once every 100 years. In the real world, it's happened about 1.5 times every single year. The risk of a massive swing is just way, way higher than the theory suggests.
Okay, so let's put it all together. We have a market with a historically high price tag, and we now know it has a much higher than expected risk of something crazy happening. So what does our master detective, Benjamin Graham, tell us to do about it? What does this mean for us?
This is where Graham's true genius comes in. He gave us a practical formula. You estimate a company's value, you figure out what profit you want, but then, and this is the most important part, you add a margin of safety. That is your buffer. It's your protection against being wrong, against bad luck, against one of those fat tail events popping up out of nowhere. It's all about protecting your money first.
And when we apply that exact formula to the market today, we get our final verdict. An investable PE ratio, a price that includes that all-important margin of safety, is probably somewhere between 15 and 18. And with the market trading at a PE of nearly 21, well, it's way, way above that safety zone. From a pure value investing perspective, the market is overvalued. So let's quickly recap the case file. 1. The U.S. stock market's price tag is in historically high territory. 2. Benjamin Graham gave us a brilliant way to separate disciplined investing from what is essentially gambling. 3. His favorite tool, the PE ratio, is basically flashing a warning sign. And 4. We've uncovered the market's dirty secret, that the risk of a truly extreme event is much higher than most people think.
And that leads us to the final, and honestly the most important question of all. This isn't really about the market anymore. It's about you. Knowing that the price is high and that the real risks are maybe higher than you thought, you have to decide. Are you approaching this market with the discipline and the margin of safety of an investor? Or are you just betting that the price will keep going up, acting as a speculator? The answer to that question will define your entire journey from here.
Today, we're jumping into a really fascinating financial puzzle. It's all about the hidden connection between the world's 2 biggest economic players, the United States and China. Now, you'd think their massive stock markets would be pretty connected, right? But on the surface, they seem to be marching to completely different beats. The question is that really the whole story?
So yeah, that's the big question we're tackling. Are these 2 giants of finance truly independent? Or is there some kind of invisible string that ties Wall Street's S&P 500 to Shanghai's CSI 300? As you're about to see, the answer is way more complex and honestly, way more interesting than you might think.
I mean, just think about the sheer scale we're talking about. Together, these 2 markets make up a huge chunk of the world's entire financial system. You've got the old guard, the established giant in the US, and then you have this incredibly fast-growing powerhouse in China. Figuring out how they interact isn't just some academic exercise. It has huge, real-world implications for investors and economies everywhere.
Okay, so before we can crack this case, we have to get to know one of our main subjects a little better. I'm talking about the Chinese market. See, it wasn't built like Western markets, and it definitely doesn't play by the same rules. We need to really understand its unique personality, its DNA, to find the clues we're looking for.
Let's start at the very beginning. Back in 1990, when the modern Chinese stock market officially kicked off, it was tiny. And when I say tiny, I mean it. It had a grand total of just 8 companies listed. 8, that's it. It was a really humble, almost experimental start for what was about to happen.
Now let's fast forward 30 years. That number, it didn't just grow, it exploded. From 8 companies to over 3,500. This created the second largest stock market on the entire planet. That kind of insane growth mirrors China's economic boom, but it also means the market had to grow up really, really fast.
Now here's where things get really different. Let's talk about who's actually doing the trading. In the US, about 80% of the market is run by the big players. We're talking pension funds, mutual funds, those kinds of institutional investors. China, It's the complete opposite. It's largely driven by individuals, by retail investors, everyday people, plus, of course, some major state-owned companies. This completely changes the psychology of the market.
And because you have a different kind of investor, you get some really unique market behaviors. For starters, the turnover, how often shares actually change hands, is often double what you see in the US. It's also incredibly sensitive to government policy, which can send things swinging wildly. And it has these guardrails you just don't see in the West, like a 10% daily limit on how much a stock can move, up or down. It's a whole different world.
So, keeping that unique profile in mind, let's finally look at our first piece of evidence. If we just compare the daily ups and downs of the US and Chinese markets, what do we find? Well, the initial answer seems almost disappointingly simple.
If you were to plot the daily returns of the S&P 500 against China's CSI 300, it would just look like a random cloud of dots. Seriously, one day the US is up, China's down. The next day, maybe they're both up. There's no clear, obvious pattern. At first glance, it looks like they're totally disconnected.
And if you do the math and calculate the overall correlation, you get a number that's only around 16%. In statistical terms, that's really weak. It basically suggests these two markets are strangers. So, case closed, right? Well, this is where our little detective story starts to get good. That first clue, it's a classic red herring.
You see, the problem with using a single number is that it assumes the relationship is always the same, day after day. But what if it's not? What if the connection between these two markets actually changes? Sometimes it's strong, sometimes it's weak. To see that, we need a much smarter tool.
And that tool is called a rolling correlation. It sounds fancy, but the idea is simple. Instead of looking at all the data at once, you look at it in smaller chunks, say over the last 90 days. Then you roll that window forward through time. What you get is a movie of the relationship, not just a single snapshot.
And once we do that, the truth becomes obvious. This connection is anything but stable. There are long stretches where the markets actually move in opposite directions. But then, during big moments of global stress, like the 2008 financial crisis, the correlation shoots up and they suddenly move in perfect lockstep. The key takeaway is that the connection isn't constant. It all depends on the circumstances.
And that leads us to the final and most crucial piece of the puzzle. The connection isn't just unstable. It's what we call asymmetric. It behaves one way under certain conditions and a completely different way under others. And it all comes down to one simple factor: whether the US market is having a good day or a bad one. This is the big reveal right here. When the S&P 500 has a positive day, the correlation with China's market the next day is practically zero. It's like good news from America just doesn't travel. But when the S&P 500 has a negative day, the story completely flips. The correlation jumps way up, and during really sharp US downturns, it can surge past 25%. It seems that fear is way more contagious than greed.
So what's the financial lesson in all of this? It's pretty simple, really. Bad news travels, and man does it travel fast. When Wall Street sneezes, Shanghai definitely catches a cold. But when Wall Street is throwing a party, Shanghai doesn't necessarily join in. It's like a one-way amplifier for all that negative sentiment.
Okay, so we've cracked the case. We've uncovered this strange asymmetric connection. But why does this actually matter to you, or to an investor, or to the global economy? Let's break down what this all means in the real world. All right, so here are the key takeaways. First off, these two markets are absolutely not independent, no matter what a simple analysis might tell you. Second, that connection is totally one-sided. China's market follows the US down, but not up. Third, the impact is intense, but it's quick. Usually it's over after just one day. And finally, and this is so important for investors, if you're investing in China to diversify and protect yourself from a US downturn, that protection might disappear exactly when you need it most. It's a huge reminder of how bad vibes from Wall Street can ripple across the entire globe.
And that leaves us with a final, really interesting question for the future. China's market is still evolving, right? More big-time institutional investors are coming in, the rules are changing. So as it keeps maturing, will it learn to shake off Wall Street's bad moods? Or is this asymmetric connection here to stay? Well, that's a story that's still being written. Thanks so much for tuning in.
Welcome to The Explainer. So today we're going to tackle a massive question, maybe the question in finance. Is there really a formula for picking winning stocks? We're going to pull back the curtain and show you exactly how quantitative investors, the quants, build these complex models to try and find an edge, to outperform the market.
All right, so is there a formula? Let's get right into it.
Now, look, obviously there's no magic crystal ball, right? Nobody can predict the future with 100% certainty. But there is a super systematic, data-driven approach that's pretty much the backbone of modern quantitative investing. And we're going to break down the logic behind it. It's called multi-factor analysis. So here's the plan. First, we'll talk about the main goal here, the quest for what's called alpha. Then we'll dig into why it's even possible to beat the market, by finding the little cracks in the system. After that, we'll check out the blueprint for one of these models, get a feel for the math that makes it work, and then finally, see how it all comes together in a real-world professional strategy. Sound good? All right, let's start with the big why. I mean, what's the point? Why would any investor go through all the trouble of picking individual stocks when you could just buy an index fund and call it a day? Well, it all boils down to one single, kind of famous Greek letter, alpha. So, in the world of quant finance, alpha is basically the holy grail. It's the concrete, measurable proof that your strategy is actually doing something special, that you're not just getting lucky by riding the market's wave. Generating alpha? That's the whole shebang. That's the entire point of active management. And so, creating an alpha model is just the fancy term for building a system that tries to predict those extra returns. Yeah, so it really comes down to a fundamental choice for any investor. You can go the passive route, right? You just accept whatever the market gives you by buying something like an S&P 500 index fund. Easy. Or you can be an active investor. That means you believe you've got a special skill or a better model that lets you pick the right stocks to actually beat the average. And that is where the quest for alpha really kicks off. Okay, but this brings up a huge and pretty logical question. If the markets are just jam-packed with super smart people, all with access to tons of information, how can anyone consistently beat them? It seems impossible, right? Well, the answer is that real-world markets, they're not perfect, not even close. They have cracks in them, or what economists like to call inefficiencies. And this, right here, really gets to the core of it. It's the classic battle between theory and reality. In the textbooks, you have this beautiful idea of the efficient market hypothesis, where all information is instantly available to everyone and we all act like perfectly rational robots. But come on, we all know that's not how the real world works. Reality is messy. People are driven by emotions, fear, greed, panic. And it's that very human element that creates the opportunities these models look for. So these are the cracks we're talking about, the ones that quant models are literally designed to find and exploit. Think about it. Investors totally overreacting to one bad earnings report, or big, powerful hedge funds getting access to research that you or I might not see. Heck, even the weird motivations inside companies or on Wall Street can create these predictable patterns. Every single one of these is a potential source of alpha. Okay, so how do we actually capture these inefficiencies in a systematic way? Well, the secret is to stop looking for that one single magic bullet answer. It doesn't exist. Instead, we're going to build a model that combines a whole bunch of different signals all at once. And you know what? There's a really simple analogy that makes this super clear. Just imagine for a second that you had to predict a person's weight. You wouldn't just use one piece of info, would you? Of course not. Your brain would automatically start building what is essentially a multi-factor model. You'd think about, their height, their gender, how much they exercise, maybe their diet, all these different things. Each one of those is a factor, another piece of the puzzle. And believe it or not, we apply the exact same logic to forecasting stock returns. It's the same idea. We just swap out the inputs. So instead of height and diet, our inputs are financial factors. We start asking questions like, is this stock cheap compared to its earnings? That's our value factor. Is the company making a ton of money? That's a profitability factor. Has its price been on a roll lately? That's momentum. See? We're literally building the same kind of model, just for stocks. Okay, this is great. We have our factors, our ingredients for the recipe, but now for the million-dollar question. How much does each one matter, right? How do we figure out the weights, those little B coefficients in the equation? We need some kind of statistical engine to figure out the best possible relationship between all our factors and what we're trying to predict, future stock returns. So when you actually plot the data, like let's say you put a company's profitability on one axis and its future stock return on the other, you don't get a nice, pretty straight line. No way. You get this, a messy cloud of data points all over the place. The whole job of our statistical engine is to look at this cloud and find the one single line that best slices right through the middle of it and captures the hidden trend. The method we use to find that magic line is called ordinary least squares. You'll hear it called OLS. Let's just walk through how it thinks, step by step. First, you've got your data cloud. Easy enough. Second, you just draw a line through it. Any line. Third, you measure the errors. What's an error? It's just the vertical distance from every single one of those little dots to the line you drew. And finally, this is the cool part, the OLS algorithm does the math to find the one line, the single best line that makes the grand total of all those squared distances as small as it can possibly be. And that, my friends, is what we call the line of best fit. And here's a pretty cool piece of trivia for you. This incredibly powerful technique wasn't invented on Wall Street. It was developed way, way back in 1795 by an absolute genius of a mathematician, Carl Friedrich Gauss. And get this, he didn't invent it for finance. He came up with it to solve an astronomy problem. He was trying to predict the location of a newly discovered asteroid named Ceres. It worked like a charm back then. And it's amazing to think that the same core logic is what powers these sophisticated financial models today. All right, so that's the theory. But how does this all come together on an actual trading floor? Let's go from the textbook to the real world and peek inside a professional-grade alpha model. Yeah, so big investment firms, they're not just using one or two signals. I mean, not even close. They build these massive models using dozens, sometimes even hundreds of different data points. And to make sense of it all, they group these signals into logical themes or factors, like the ones you see here. They're basically asking a whole series of smart questions. Is the stock cheap? That's value. Is it a high-quality, profitable company? That's profitability. Does it have good momentum? Is its accounting legit? Is management making smart moves? What are the analysts saying? They want to know everything. Now, this next part is maybe the most important and least glamorous part of the whole process. Before you can run a single bit of math, you have to deal with a harsh reality. Real-world financial data is a complete mess. It's noisy, it's biased, it's just messy. And cleaning it up is absolutely critical. A raw number might have some crazy outlier that would just wreck the whole model. You have to adjust for industry quirks. I mean, a cheap bank is a totally different beast than a cheap software company, right? And finally, you have to put everything on the same scale, standardize it, so that a value signal can be fairly compared to a momentum signal. It is all about making sure you're comparing apples to apples, not apples to oranges. So, after all that intense data cleaning and prep work, it all comes together. The different themes, value, momentum, quality, and all the rest, are combined into one final, multi-factor alpha model. The OLS regression is run on years of historical data to figure out the best weights, those B coefficients, for each theme. And what comes out the other end? A powerful machine that spits out a single, forward-looking alpha score for every stock in its universe. And it does this every single day. Okay, so we've been on quite a journey here, on this quest for a stock-picking formula. Let's boil it all down to the key takeaways. All right, let's wrap it up. Here's what you really need to remember. First, active investing is all about the hunt for alpha, and that's only possible because markets aren't perfect. Second, these multi-factor models are just a smart, systematic way to hunt for that alpha by combining lots of different clues. Third, that statistical engine, OLS, is what figures out the recipe, how much of each ingredient to use. And maybe most importantly, none of this works on autopilot. It needs human insight. It's the art of picking the right factors and the science of cleaning up the data. And all this leaves us with a really interesting and kind of provocative final thought. We've just walked through this process that seems so scientific, so automated, right? But think about it. Every single step we talked about, from spotting an inefficiency in the first place to choosing which factor to use, all of it relied on human judgment. So, as these models get more and more powerful, you really have to wonder, where does the science end and where does the art begin? It's a great question to think about. Thanks for joining me for this explainer. Welcome to The Explainer. Today, we're going on a hunt for the most sought-after prize in all of finance, alpha. You know, that's the secret sauce, the ability to consistently beat the market. And we're going to crack open the professional's playbook to see exactly how they find it. So, what's the real difference? What separates a fleeting good idea from a great one that just keeps on winning? I'll tell you what it's not. It's not a lucky guess, and it's not some hot tip. It's actually a rigorous scientific process, and we're going to break that entire process down step by step. All right, here's our game plan. We're going to start with a basic guide to alpha hunting. Then we'll look at a really common and dangerous trap that a lot of people fall into. After that, we'll get into the professional solution, why it's so important to see the market's hidden complexities. And finally, we'll run through the ultimate checklist professionals use before they ever put an idea to work. Okay, so you've got this huge financial wilderness out there. Where do you even start looking for alpha? Well, you don't just wander around hoping to get lucky. You start with a compass. For professionals, that compass is a framework, a set of 5 key criteria they use to check out any new idea, and it's called I-Pray. These 5 principles are basically your quality filter. First up is the idea intuitive. Is there a real common sense economic reason for it to work? It can't just be some random pattern you found. Second, is it predictive? A good story is nice, but does the data actually back it up? Does it forecast future returns? Third, is it robust? A truly great idea shouldn't just break the second you change a small detail or when the market gets a little shaky. Fourth, is it additive? This one's huge. Your new idea might work, but is it telling you something you don't already know from your other strategies? And finally, maybe the most practical one, is it executable? A genius strategy is totally useless if trading costs are just going to eat up all your profits. So now, let's say you've used your compass. You've found a factor that checks all the boxes, and it looks really predictive. You're getting excited. But hold on, because there's a huge trap waiting for you, and it's the tendency to think about your great new idea separately from its risk. This is exactly where so many promising strategies just completely fall apart. And the core of this trap, really, it all comes down to how we think about risk. Most of us are taught that risk is just volatility, the standard deviation of returns. The more a stock's price jumps around, the riskier it is. It sounds simple, it sounds right, but that simple definition can be incredibly misleading. This picture illustrates the problem perfectly. Okay, look at the chart on the left. You've got security A and security B. They have the exact same volatility, but one made you a 50% return and the other lost you 50%. Calling their risk identical it's absurd. Now look at the right. Security C looks safer, right? It had some ups and downs. Security B just went straight down. But using that flawed volatility measure, C is actually considered more risky. You can see how this way of thinking is just fundamentally broken. And here's where it really hurts. When you go to build your portfolio, you have to adjust for risk. And if you've been ignoring it up to this point, that beautiful clean signal on the left just gets completely scrambled. It's a mess. After you apply that flawed risk adjustment, your best ideas, the stocks you ranked at the very top, suddenly look kind of average. And your worst ideas might even look good. Poof! All that hard work you did to find the signal, it just went up in smoke. So, how do the pros avoid falling into this trap? Well, it's simple. They don't treat risk like some afterthought. They bake it in from the very beginning. They integrate risk and return right from the start using a really powerful statistical tool called weighted least squares, or WLS for short. Now, to really get why WLS is such a game changer, you have to understand the problem with the standard approach, which is called ordinary least squares, or OLS. Now, OLS is the workhorse of statistics, but it has one major flaw. It treats every single data point, every piece of information, as if it's equally important and equally reliable. And in the real world of financial markets, we know that's just not true. And this slide right here, this is what real financial data actually looks like. It's not some neat little cloud of points. No, it's messy. It fans out. The fancy term for this is heteroscedasticity. But all that really means is that some of your data is way noisier and less reliable than the rest of it. And a standard OLS model just gets totally confused by all that noise. And that is where WLS comes in. It's the solution. Think of it like a super advanced targeting system. It intelligently looks at all the data and gives more weight, more importance to the clean, reliable points, while at the same time, it dials down the importance of the noisy, uncertain ones. By doing this, it builds a risk-adjusted alpha signal right from the ground up, making the whole thing way more robust and way more efficient. Okay, but we're not done yet. Even with a powerful tool like WLS, we're still making one pretty big assumption, and that is that the relationships we're looking for are simple and linear. A straight line. But in reality, the market is way more complex than that, and sometimes that simple story is just a flat-out lie. So let's take a classic value factor, like the book-to-price ratio. At first glance, it looks perfect. Here, we've just sorted all the stocks into 5 buckets, from most expensive to cheapest. And look at that chart. It's beautiful. It's a clean, straight line up. The cheaper the stock, the higher the return. Simple, right? Case closed. Let's go home. But
What happens if we zoom in? What if, instead of 5 big buckets, we sort the stocks into 20 smaller ones? Now we can see what's really happening at the edges. And boom, the illusion is shattered. The relationship holds true for most of the stocks. But look way over on the far right. The absolute cheapest stocks, what people call deep value, they actually underperform. This is the classic value trap. These stocks are cheap for a very, very good reason.
This 3D plot really shows us the hidden terrain. It's showing the interaction between two things: being cheap, that's our book-to-price ratio, and another fundamental quality, like sales growth. The peaks, the highest points on the map, those are the stocks with the best returns. And where are they? They're stocks that are cheap and have high sales growth. Now look at that deep, dark valley. That's where cheap stocks with negative sales growth go to die. It's not enough to be cheap. Context is everything.
So, with all of these complexities, the flawed risk metrics, the noisy data, these hidden relationships, how do professionals actually navigate all of it? Well, they don't guess. They use a comprehensive diagnostic package to systematically vet every single factor before they risk a single dollar. And here it is. This is the final playbook. It's a super rigorous checklist that pulls together everything we've just talked about. They check the factor's distribution to look for crazy outliers. They test its forecasting power, not just overall, but in market booms and in market busts. They analyze its risk profile to see what other things it moves with. They measure information decay. That's how fast the edge actually disappears. They analyze turnover because they need to know if trading costs will kill the whole thing. And they absolutely confirm its marginal value to make sure it's not just redundant. This is how you build a strategy that's actually ready for the real world. So you see, the hunt for alpha isn't really about finding some single magic formula. It's a relentless scientific process of always questioning your assumptions, navigating around flawed metrics, and digging deep to see the hidden complexities in the market. It's really about building a robust process, not just finding one good idea. The real takeaway here is that every simple investing truth probably deserves a much closer look. So, which one are you going to question next?
Welcome to The Explainer. Today, we're jumping headfirst into the really tricky world of commodity forecasting. We're going to tackle a huge question. How in the world do you predict something as wild as the price of oil? And what you're about to see is a fundamental truth, that sometimes the data we rely on the most can actually be lying to us.
Okay, let's get right into it. To really get a handle on this puzzle, we're going to zoom in on one of the most critical and, frankly, most unpredictable commodities out there: crude oil. You know, its price affects pretty much everything, from what you pay at the pump to the cost of your groceries. So the big question is, how can anyone possibly know where it's going next?
Just take a look at this chart. It shows the price of crude oil going all the way back to 1861 and up to 2017. I mean, it is a roller coaster, isn't it? You've got these calm periods, these upward trends that look like they'll never stop, and then bam, these massive, sudden shocks that send prices through the roof or crashing down. This is a perfect example of what we call time series data, where the sequence of what happens when is everything.
Now, if you look really close at that chart, your gut tells you something, right? It just feels like today's price is going to be pretty darn close to yesterday's. And you're not wrong. Statistically, the correlation from one day to the next is over 99%. Seems like a sure thing. But here's the catch. That visual connection, that intuition, is hiding a really dangerous statistical trap.
So what exactly is this trap? Well, we're about to peel back the layers on this thing and introduce you to the villain of our story. It's a tricky concept, one that catches even the pros off guard, and it's called a spurious relationship.
To really get this, let's use a super famous example. If you were to track ice cream sales and drowning rates, you'd see something weird. They often go up and down together. The correlation is strong. But does eating a scoop of chocolate fudge cause people to drown? No, of course not. There's a hidden factor, a third wheel, which is just summer heat. Hot weather makes people buy ice cream, and it makes more people go swimming. And that, my friends, is a spurious relationship in a nutshell.
So here's the big takeaway. Just because two lines on a graph are moving together, it absolutely does not mean one is causing the other. That connection you see, it could be a total illusion. It might be pure coincidence, or just like with the ice cream, some other invisible force at work. And when you're dealing with economic data, that's a massive risk.
And this is where it gets kind of crazy. This chart shows the problem in its purest form. These two lines you see on the screen, they were made up by a computer. There is zero connection between them. They are totally, completely unrelated. And yet, look at those numbers. The correlation is a mind-blowing 93%. A regression analysis would tell you one explains 87% of the other. It looks like a powerful, rock-solid relationship, but it's 100% fake.
So you're probably asking, how is that even possible? Well, the secret ingredient to this statistical magic trick is something called a unit root. Think of it this way. Most data is kind of anchored. It likes to hang around an average. But a series with a unit root, it has no anchor. It's on a random walk, just wandering around with no memory of where it came from. And because it's just drifting, it can very easily drift in the same general direction as another random walk, creating this powerful illusion that they're connected.
So, if data can pull off such a convincing lie, how do smart analysts and investors not fall for it? Well, they know they can't just trust their eyes. They have a special toolkit, a set of methods designed specifically to see through these illusions before they make a very, very bad call.
It's a really strict three-step process. First things first, you have to test for trouble. You run a specific test to see if your data is on one of these dangerous random walks. If the test comes back positive, you go to step 2. You change the data, you transform it to make it stable, and only then, once it's safe, do you go to step 3 and rerun your analysis to find out what's really going on without all the statistical ghosts.
And that main weapon for step 1, the big test, is called the Augmented Dickey-Fuller test, or just the ADF test for short. Its entire purpose, its only job, is to look at your data and give you a straight yes or no answer to one critical question. Does this data have a unit root? It's the gatekeeper that tells you if you're working with something predictable or something deceptively random.
So what does fixing the data actually look like? Well, if that ADF test says you've got a problem, you can't just use the raw price numbers. Instead, analysts will do something like this. For instance, instead of looking at the price of oil itself, they might look at the change in price each day, or the daily percentage return. What these tricks do is they strip out that random walk behavior, making the data stable and safe to analyze again.
All right, enough with the theory. Let's put this new toolkit to work. We're going to look at a fascinating, real-world relationship that has had investors talking for decades. The seemingly ironclad link between the price of oil and the price of gold.
Now, at first glance, these two couldn't be more different. Oil is what makes the world run. It's all about industry, supply, and demand. Gold, on the other hand, it's not really used for much. It's a safe haven, the thing people buy when they're scared about the economy. And yet for years and years, it looked like their prices were dancing together in perfect sync. The logic was, when oil prices go up and hurt the economy, investors run to the safety of gold.
And the numbers? Wow, the numbers seem to scream that this is true. The statistical correlation between the monthly prices of oil and gold is a massive 86%. I mean, come on, 86%. You look at that and you think, okay, case closed. This is a real, fundamental connection.
But hang on a second. We know better now, don't we? We've just seen how easy it is for data to trick us. So we have to ask the hard question. Is this incredible 86% link the real deal? Or is it just another beautiful lie? Another case of two random walks that just happen to be heading in the same direction for a while?
To figure that out, we need one more concept, a slightly more advanced one called co-integration. And the best way to explain it is with this great metaphor of a drunk person walking their dog. Okay, so think about it. The drunk person is on a random walk, right? And the dog is also on a random walk. But the dog is on a leash. They're tied together. They might both wander all over the place, but the dog can't get too far away from its owner. So co-integration asks, are oil and gold, like the drunk and their dog, fundamentally tethered together? Or are they just two separate drunks who stumbled out of the same bar?
And here it is, the big reveal. After running all the proper statistical tests, the verdict comes back, and it is a shocker. The prices of oil and gold are not co-integrated. That incredible 86% correlation, it's basically a statistical mirage. They aren't on a leash together. They are two separate drunks wandering off on their own, and their apparent connection was just an illusion.
So, what's the big lesson here? What this whole explainer has been building to is this. You absolutely cannot rely on statistics alone. A huge correlation number is not proof of anything. Real, effective forecasting means you have to combine the numbers with a deep, real-world understanding of what's actually driving the market.
And this timeline for oil just drives that point home perfectly. I mean, look at what really causes the price to go haywire. It's not a random number generator. It's the 1973 oil embargo. It's the Iranian Revolution in '79. It's the Gulf War, the 2008 financial crisis, the Arab Spring. These are huge, world-changing events that completely alter the balance of supply and demand.
At the end of the day, any good forecasting model for something like oil can't just be a math problem. It has to include these powerful real-world forces. You have to think about economic growth in places like the US and China. You have to watch what OPEC is doing. You have to be aware of the constant risk of wars and crises. And you even have to track the US dollar. These are the fundamental drivers that a simple line on a chart can never, ever capture on its own.
And that really leaves us with a big final thought to chew on. We just watched an 86% correlation, a relationship that looked as obvious and true as anything, completely vaporized into a statistical phantom. So it really makes you wonder, if data that looks this clear can be so wrong, what other obvious truths that we see in charts and headlines every single day should we maybe start questioning a little bit more? Thanks for joining this explainer.
All right, today we're going to get into the nitty-gritty of how professional investment portfolios are actually built. We're talking about the real science behind it all, how the pros go from having a simple idea about a stock to building a full-blown, risk-managed collection of assets. So let's start with a question every single one of us has faced. You've got some cash, say 10 grand, and you want to put it to work. But where do you even begin? Do you jump on that hot tech stock everyone's buzzing about? Play it safe with a company that pays dividends? Or do you just try to spread it out and hope for the best? It's this constant battle, right? That classic tug of war between chasing big returns and trying not to lose your shirt. You know, for most people, the answer to that $10,000 question comes down to a bit of Googling and a whole lot of gut feeling. But in the world of professional quantitative investing, guessing just isn't part of the equation. The whole point is to build a portfolio where every single decision is deliberate, it's mathematical, and it's all based on a framework that literally won a Nobel Prize for changing the game. So let's dig into how they do it. Okay, so before we jump into the amazing solution, we really have to get a handle on the problem itself. What is it that we're actually trying to build here, and what are the basic rules of the game? Let's lay out the building blocks.
At its core, a portfolio is, well, it's just a bunch of stuff you own. For our purposes today, we're going to focus on a collection of stocks. But the real magic, the absolute central puzzle of building a portfolio, isn't just deciding what stocks to buy. The much, much harder question is how much of each one to own. That weighting, that allocation, that's everything.
Now, portfolios basically come in two main flavors. On the left, you've got long only. This is how most of us invest. You buy stocks you like, and if you really don't like a company, well, the most you can do is just not own it. Your bet can't go below zero. But on the right, you have long short, and this is a whole different ballgame. Here, you can still buy stocks you think will go up, that's the long part, but you can also actively bet against stocks you think will go down by short selling them. It gives you way more freedom, but man, is it a lot more complex.
So how do you measure just how different a portfolio is from the overall market, like the S&P 500? That's where this thing called tracking error comes in. The easiest way to think about it is as a leash. It's a measure of activeness. A low tracking error means your portfolio is on a short leash. It performs a lot like the index. But a high tracking error? That means you're on a really long leash. Your returns could be wildly different from the market, which could be amazing or it could be terrible.
And this is a perfect real-world example of a very long leash. This is Warren Buffett's performance against the S&P 500. Just look at these numbers. In 2009, he underperformed the index by a massive 23.8%. But then look back at 2008, during the financial crisis, he actually beat the market by over 5%. These huge swings, these big bets for and against the market are what give him a super high tracking error of over 11%. This portfolio is making a statement. It's definitely not trying to hug the index. So with all these moving parts, how on earth do you manage that trade-off between risk and reward in a structured, scientific way? Well, that brings us to the hero of our story, an economist named Harry Markowitz, who back in 1952 basically changed finance forever. You see, before Markowitz, the whole game of investing was about finding that one perfect stock. People were hunting for needles in a haystack. His insight was, frankly, revolutionary. He said, stop focusing on individual stocks. The portfolio as a whole is what really matters. It's not about the parts, it's about how those parts work together, how they move in relation to each other. And this is the fundamental question that Markowitz wanted to answer. It's so simple and yet so profound. He said, forget trying to find some magic stock. Instead, let's think like an engineer. For any level of risk that I am willing to accept, what is the absolute best, mathematically optimal return I can possibly squeeze out? And boom, here's his beautiful answer. Every little dot on this chart is an individual stock. You've got its risk along the bottom and its expected return up the side. Now, you could combine them in literally millions of different ways. But the only combinations that actually matter are the ones that fall along this curved line. That's the efficient frontier. If your portfolio is on that line, it's optimal. If it's below that line, it's inefficient. You're taking on more risk than you have to for the return you're getting. Simple as that. And this all leads to one of the most famous sayings in finance. The reason the efficient frontier is curved and not a straight line is because of diversification. By combining assets that don't all move up and down at the exact same time, you can actually lower your total portfolio risk without having to sacrifice any expected return. It's the closest thing to a free lunch you're ever going to find. Okay, so the efficient frontier is an incredible idea, but it's just a concept, right? How do we actually, find it? How do we calculate the perfect portfolio weights when we have thousands of different stocks to choose from? That's where we move from theory to practice. The tool for the job is called mean variance optimization, or MVO. Don't let the name scare you. Just think of it as a super powerful algorithm. You feed it two key things for every single stock: its expected return, which quants call alpha, and its expected risk, or variance. Then the optimizer goes to work and solves this giant mathematical tug-of-war, finding the absolute perfect balance to give you the best bang for your buck. So how does the optimizer know which point on that efficient frontier you want? Well, you tell it, using a little parameter called lambda. The best way to think about lambda is as your personal risk aversion dial. If you turn the dial down low, you're telling the optimizer, go for it, I want high risk and high return. If you crank the dial way up, you're saying, whoa, play it safe. I want to minimize my risk, even if it means lower returns. You literally get to choose your spot. I mean, this all sounds pretty perfect, doesn't it? We have a Nobel Prize-winning theory, we've got a powerful algorithm to do the math. What could possibly go wrong? Well, as it turns out, the real world is a whole lot messier than the clean, perfect world of the model. And this is where the theory slams right into a very big, very real wall. Yeah, some of the critics of this classic approach have a pretty brutal nickname for it. They call it an error maximizer. And here's why. The optimizer is incredibly sensitive. It hangs on your every word. If your forecast for a stock's return is off by even a tiny, tiny fraction, the optimizer can take that little error and just run with it, making massive, wild changes to the portfolio. It treats your inputs like they're perfect gospel, when in reality, they're just educated guesses. It basically amplifies any small mistake into a potentially huge problem. Now, people knew about these flaws for a while, but it was the 2008 global financial crisis that was the real wake-up call. When all the normal models completely broke down in the chaos, investors were desperate for something new, something more robust. And you can see the result right here on this slide. It's incredible. On the left, you see the money managed by these so-called smart beta funds. Look how it's just kind of flat for years, and then right after 2008, it just explodes upwards. It's a rocket ship. Investors were pouring money into these new ideas. And the chart on the right shows you which idea they liked best. That bar on the far left, for low volatility strategies, just towers over everything else. This wasn't a small change, it was a revolution, born directly out of that crisis. So what is this revolutionary approach? It's actually brilliantly simple. The quants looked at mean variance optimization and said, okay, the mean part, our forecast for returns, that's the part we can't trust. That's where all the errors are coming from. So let's just throw it out. And that's what they did. Minimum volatility strategies completely ignore expected returns. They use the optimizer for just one single job. Build me the portfolio with the absolute lowest possible risk. Full stop. So what does a portfolio like that actually look like in practice? Well, this chart gives you a pretty good idea. It is packed with defensive sectors. You've got consumer staples, think companies that sell things we all need to buy no matter what, like food and toothpaste. You've got utilities, the companies that provide our electricity and gas. These are businesses that tend to chug along steadily, whether the economy is booming or busting. And because of that, they tend to be way less volatile. All right, so we have these powerful theories, we have these clever strategies, but there's one final and maybe most important step. we have to test them. How do we know if any of this is actually going to work before we put real money on the line? This cartoon, it's a bit of an inside joke in the quant finance world, but it gets at a really profound truth. A backtest is just a simulation of how your strategy would have performed in the past. And while it's a critical tool, it's dangerously easy to build something that looks like a world beater on historical data, only to watch it completely fall apart the second it has to face the real, unpredictable future. And really, that leaves us with a fundamental question that everyone in modern portfolio construction is grappling with. If we accept that a perfect model is impossible, what's more important? Do you spend all your energy trying to create a slightly better prediction, a better alpha, knowing deep down that it will always be flawed? Or do you focus instead on building a tougher, more resilient process, one that's designed to withstand the inevitable errors and the messy reality of the markets? There is no easy answer, and that very debate is what's shaping how trillions of dollars are being managed around the world every single day.
All right, let's talk about a massive, and I mean massive, blind spot in finance. You know, we're all taught to think in terms of averages. But what if I told you that focusing on the average is actually a dangerous illusion? Today, we're going to explore why those rare, extreme events, what we call tail risk, are often the only risks that truly matter. And, more importantly, how a whole new way of seeing data can help us finally prepare for them.
So here's the game plan. First up, we're going to completely shatter this myth of the bell curve in finance. Then we'll get into a totally new way to think, in quantiles, not averages. We'll look at a really powerful tool called quantile regression, see how it actually forecasts extreme events, and then we'll bring it all home to see how this leads to building way smarter, more resilient portfolios. Let's dive in. Okay, first up, the myth of normal. You know, for decades, pretty much all of foundational finance, I'm talking portfolio optimization, options pricing, the whole shebang, it's all been built on this one super convenient assumption, that market returns follow a nice, neat, tidy bell curve. The problem is, they don't. Not even close. And that little detail, oh, it matters a lot.
I mean, it really all comes down to this one simple question, right? If our models were actually that good, events like the 2008 crisis or the dot-com bust, they wouldn't feel like they just came out of nowhere. The reason these things are always such a shock to the system is that our standard tools are fundamentally, structurally blind to what's happening out at the extremes.
Okay, so take a look at this. This is what reality actually looks like. Forget that smooth, gentle bell curve from your textbook. On the left, you've got daily returns for Japan's Nikkei, and on the right, monthly returns for gold. Notice that tall, sharp peak in the middle? And more importantly, look at the sides, those fat tails. They are way, way thicker than a bell curve would suggest. That's where the surprises live. That's where you find the massive drops and the epic rallies that our models keep telling us are basically impossible.
And this is the direct result. When your model assumes everything is normal, it dramatically, dangerously underestimates the probability of a catastrophic event. It'll treat a 5 standard deviation crash as a once-in-a-million-years event. But in reality, we've seen several of those in just the last few decades. This is the very definition of tail risk, the risk that your portfolio gets completely vaporized by an event your model swore up and down couldn't happen.
Let's make this tangible, because this table is just incredible. Look at the Japanese market. Its annualized return was about 4.8%. Okay, fine. But what if you could magically remove the single worst 1% of trading days? Just poof, they're gone. That return jumps all the way to over 17%. Now flip it. What if you just happen to miss the best 1% of days? You would have actually lost over 5% a year. And the story's even more dramatic for Russia. You go from 14% to a staggering 46% just by avoiding the absolute worst days.
Just let that sink in for a second. For some of these assets, avoiding a tiny, tiny fraction of the worst days could multiply your returns by nearly 20 times. That's the whole takeaway here. Your long-term success isn't built on average days. It's won or lost in a handful of extreme ones. So managing the tails, that isn't just a part of risk management. It is risk management. Okay, so we've established that the average is a problem. It hides all the most important information. So let's move on to the solution and see how we can build a much better, clearer picture of risk. It all starts with a simple shift in perspective. To fix our broken models, we have to go back to Statistics 101. Remember the difference between the mean and the median? The mean, your regular old average, can be wildly distorted by one extreme value. Just like the slide says, one billionaire walks into a room and suddenly the average wealth is in the millions. It's totally misleading.
The median, though, the median is robust. It's the true midpoint, and it couldn't care less about that one outlier. It gives you a much more realistic picture. This is the very first step to thinking beyond the average.
Now, quantiles are what take this idea and give it superpowers. If the median slices the data neatly in half, that's the 50th percentile, quantiles let you slice that data into any number of pieces you want. You can look at the 10th percentile, the 90th, the 99th, whatever you want. This lets us ask much more interesting questions. Not just what's the middle, but what do the worst 10% of outcomes look like? Or what about the best 5%? It lets us zoom right in on those tails.
So now let's introduce the revolutionary tool that actually allows us to apply this quantile thinking to build these incredibly powerful financial models. It's called quantile regression.
And what's fascinating is that this idea is not new at all. The concept of modeling the median, it actually predates the average-based methods we all use today by about 50 years. Crazy, right? The problem was, it was incredibly difficult to compute by hand, so the simpler least squares method just took over. It wasn't until the computer age and the groundbreaking work of Roger Koenker and Gilbert Bassett in 1978 that we could finally unlock its true potential.
And this quote from Koeninger himself just perfectly illustrates the core idea. He describes it as a way to explore data features that are invisible to traditional methods. I love that word, invisible. It's not about replacing the old models. It's about complementing them by giving us a complete picture of the relationships in our data. So here's the fundamental difference. A standard regression model, it's technically called ordinary least squares, or OLS. It can only give you one answer, the average. Think of it like looking at a crowd of people. OLS can only tell you the average height. That's it. But quantile regression is way more powerful. It's like a special lens that can also tell you the height of the shortest 10% of people, or the tallest 10%, revealing how things change at the extremes.
Okay, theory is great, but let's see how this new lens works in the real world. We're going to look at a fantastic case study right from the source material, the relationship between the price of gold and the U.S. unemployment rate.
So if we use a standard model, it's just going to spit out a single number. It might tell us that, for example, a 1% increase in unemployment leads to a $90 increase in the price of gold, on average. It's a useful piece of information, sure, but it's also dangerously incomplete, as you're about to see.
But now, watch what happens when we apply quantile regression. This chart is the key. That flat dashed line in the middle, that's the single average answer from the old model. It says the relationship is always the same. But look at the solid curved line. That's the quantile regression result. It shows how the impact of unemployment changes across the whole spectrum of gold prices. And boy, does it tell a much richer story.
And here it is, the crucial point. When gold prices are low or average, unemployment has a pretty modest effect. But look at the right side of that chart. When gold prices are already high, in times of crisis, the impact of rising unemployment becomes more than 3 times stronger. The relationship isn't static. It intensifies exactly when it matters most, a critical detail that is completely invisible to an average-based model.
Okay, this is a seriously powerful forecasting tool, but how does that help an investor build a better portfolio today? Let's connect the dots because this is where it really gets practical.
This right here is a fundamental shift in thinking. The old way defines risks simply as volatility, and it makes this bizarre assumption that a huge, unexpected gain is just as risky as a portfolio-crushing loss, which is just crazy. The new way, quantile optimization, is way more intuitive. It lets us define risk as what we actually care about, the potential for a catastrophic loss. You can build a portfolio specifically designed to defend against that worst-case scenario. And that's the ultimate payoff. Instead of building a portfolio that performs well in some theoretical average market that rarely ever exists, you can build one that is stress-tested and designed to be robust during the very downturns that destroy wealth. You're no longer just hoping for the best, you are actively planning for the worst.
So let's zoom out one last time and summarize the central message here. Why does the shift in focus from the average to the tails matter so much?
To recap, this new approach, powered by quantile regression, gives us a toolkit with 3 incredible advantages. 1, it's robust. It's not easily skewed by those wild outliers that happen all the time in finance. 2, it reveals the full picture, not just a single misleading average. And finally, it's distribution-free. It doesn't try to force reality into a neat bell curve. It works with the messy, fat-tailed data of the real world.
And this brings us to our final thought.
Because this really isn't just about finance. This is a new way of thinking about risk and reality in any complex system. So I'll leave you with this question. If focusing only on the average can make us so blind in our portfolios, what crucial extremes are we missing elsewhere in our lives?
Welcome to The Explainer. Today, we're going to talk about a really powerful investment strategy, one that was born from the rubble of the 2008 financial crisis. It's an approach that tries to combine the street-smart savvy of a detective with the cold, hard processing power of a machine.
Okay, so here's our game plan. First, we'll get a lay of the land, the two classic ways people think about investing. Then we'll look at the hybrid solution that popped up when those old ways failed. We're going to dive into a fascinating real-world case study to see how it works, break down how you actually build one of these strategies, and then wrap up by asking, hey, is this the future?
You know, to really get a handle on this new way of thinking, you've got to understand the old ways first. For a long, long time, the investment world has basically been split into two camps, two totally different philosophies for picking stocks.
So on one hand, you've got the fundamental detective. Just picture someone who visits the factories, who has coffee with the CEO, who really digs deep into just a few companies they think are winners. And then on the other hand, you've got the quantitative machine. This is the statistician using super powerful computers to sift through thousands of companies, looking for patterns in historical data.
For the longest time, these two worlds, the detective and the machine, they didn't really talk to each other. They stayed in their own lanes. But then, bam, 2008 happens. The financial crisis was like this massive, brutal stress test that pushed both of these methods past their breaking point, and it laid bare some really critical weaknesses. It showed everyone we needed something better.
So here's the bottom line. The human detectives, well, they were just human. They were susceptible to their own biases, their emotions, and because they were so focused on a few stocks, they missed the massive risks building up in the bigger picture. And the machines, well, they were basically just driving by looking in the rearview mirror. And worse, a lot of them were using the same models, so they all stampeded off the same cliff together. That's a dangerous thing called crowding, and it can lead to absolute disaster.
Okay, so the crisis basically blew up the old models. What now? Well, the solution that came out of all that chaos wasn't just mixing the two old ways together. No, it was a true organic synthesis, a brand new approach designed to be much more resilient.
They called it Quantamental investing. Now, this isn't just about sticking a quant team in one room and a fundamental team in another and hoping they talk. Nope. This is about weaving the two ways of thinking together at every single step of the process. The goal is simple: get the best of both worlds.
And look at this table. This is where you can really see the magic. It's all about where you get your edge, your alpha. The fundamental detective has depth. They know a few companies inside and out. The quant machine has breadth. It sees the whole market systematically. The Quantamental approach, it's designed to give you both depth and breadth. It aims to build a much more complete, much more powerful picture.
You know, when you think about it, the logic here just makes sense. A stock's price doesn't just move for no reason, right? It's pushed and pulled by the overall market, by its industry, and then by two other key things: statistical factors that quants love to track, and those unique company-specific stories that the detectives uncover. Quantamental investing is all about trying to capture both of those last two pieces of the puzzle.
Okay, so that's the theory. It sounds pretty good, right? But what does this actually look like in the wild? Let's walk through a perfect real-world example of how a human insight got supercharged by machine power to create a killer investment strategy.
So picture this. You've got a seasoned portfolio manager, someone who reads financial statements for a living, and she starts noticing something fishy. More and more companies seem to be using this little accounting line item called special items to report negative numbers. Her gut tells her they're using it as a kind of dumping ground to hide bad news, especially at the end of the year when no one's paying close attention.
Now, the old-school detective might have just used that hunch on a few stocks, but she took it to the machine. She tested her idea across the entire market with hard data, and what she found was, wow. Her hunch wasn't just a hunch. It was a cold, hard, statistically significant signal. The data proved that companies playing these games consistently underperform the market by about 1% before their next earnings report. But wait, it gets even crazier. They found this incredible persistence. I mean, listen to this. A company that was in the worst group for these negative special items in one quarter had an 87% chance of being right back in that same group the very next quarter. That's not a one-time thing. That's a pattern. That's a habit.
And when they looked at it over the long haul, this signal really showed its value.
A strategy of shorting these companies, which is just a fancy way of betting their stock price will drop, would have been a consistent winner for over a decade. You can see it right there in that chart for the Canadian market. It was a reliable way to spot companies that were going to fall behind.
So let's look at the final scorecard here, because the numbers are just brutal. That portfolio of companies with the funky special items, it actually lost 1.25% per year. Meanwhile, the overall market benchmark gained almost 8%. And that Sharpe ratio at the bottom, you can think of it as your bang for your buck on risk. A negative number is basically saying, all pain, no gain. It was a total dud. This was a perfect example of turning a human idea into a scalable, data-driven strategy.
So this whole special items thing is a great story, but what's really important is that it gives us a blueprint, a recipe we can follow. A real Quantamental strategy isn't just a random mix of things, it's built on 3 core principles that make sure you get the best of both worlds and not the worst.
So here's the playbook, the 3-step process. Step 1. It's got to start with a human idea, a real economic reason for why something should work. That stops you from just finding random patterns in the data that mean nothing. Step 2. You take that human idea and you stress test it with data. You prove it. That's what gets rid of personal bias. And step 3. You wrap the whole thing up in a solid, repeatable process so it's consistent and transparent.
And what's cool is that this works both ways. It's not just one team learning from the other. A traditional quant team can start bringing in that human element, those deep dive insights to add real-world context to their models. And a fundamental team, like the one in our case study, can start using these powerful quantitative tools to add breadth, to test their hunches, and to manage risk way more effectively.
So, after all that, what does this actually mean for the future of managing money? Is this hybrid model the real way forward?
Well, think about it. Even the greatest fundamental investor of all time, Warren Buffett, talks about things that are, really squishy and hard to measure, things like the quality of management. For a pure quant model, that's always been a huge challenge. How do you put a number on that?
This is where the Quantamental approach just totally shines. The fundamental manager goes out, they shake hands, they use their experience to get a gut feel for who the good management teams are. And at the same time, the quant is in the background crunching the numbers on what management actually does, how they spend money, how they raise it, to systematically spot the signs of bad management. You put those two together and bam, you get this amazing 360-degree view.
And don't think this is just some little trick for one market. No, this framework is a global powerhouse. Research shows that it can be applied all over the world, from North America to Japan, creating strategies that have the potential to consistently and significantly beat the old-school benchmarks.
And that really leaves us with one final big idea to chew on. For years, the whole debate has been framed as a battle: human intuition versus machine processing. But what if that was always the wrong question? What if the real lasting edge in investing was never about choosing one over the other, but about finding the absolute best way to combine them?